game or it'll go down the heat. When you're really, which is interesting, you're badly tired, you're just scraping through with the sleep, every reason to when you get the
Take that one a little bit.
talking. We've just come. I did, yeah. Probably getting all aggro. He's going to be. What about the microphone? Oh,
Ladies and gentlemen, welcome to the National Press Club. We're very pleased this afternoon to welcome as our guest speaker the Treasurer, Mr. Paul Keating. It's fairly obvious in all the circumstances of the last couple of months what he's here to talk about today. The release of the draft white paper on taxation yesterday offered us the occasion to invite him here today to develop further the points that were made in the release of that paper. I'm very pleased to introduce to you the Treasurer, Paul Keating.
Kent, thank you very much for the invitation. I always enjoy appearing at the Press Club, and I always enjoy free meals, though this may be my last, but I've made the best of it. Well, at least you've had 24 hours or so to read and absorb the government's white paper on tax reform. Naturally, there has already been some focus on the winners and losers, on net tax cuts on the one hand and the closure of certain tax shelters on the other. It is timely, therefore, to stress again that the draft white paper and the government's preferred approach are about the achievement of a reformed tax structure. Our preferred approach is not directed to cutting taxes, though there would be tax cuts for the majority of Australians. Nor is it about tax increases, though there would be increases for those who have not been shouldering their full share of the tax burden. But tax cuts and increases are the reflection and not the essence of the basic requirement of reform. The government wants to grasp the nettle of tax reform because it is long overdue, it's urgent, and it is crucial to a continuing improvement in Australia's living standards. Reform must also be seen in the context of the Labor government's basic objectives of ensuring a better, fairer and more rewarding future for all Australians. All of the government's major policies have been directed to those ends. Reform of the Australian tax system cannot be separated from those basic objectives, nor can those basic objectives any longer be assured without such reform. It is now well recognised that the Australian tax system is unfair. It is also widely recognised and appreciated that it encourages inefficiency and is extraordinarily complex. Clearly, there is a need for action, for reform. The present Australian tax system rewards avoidance and evasion. It is manifestly unfair and it is exceedingly complex. In the past, ad hoc remedies have been used to shore up the Act when problems arose. But we must stop dealing with symptoms. The tax laws are in need of radical surgery. That is what the white paper is about. It's about fundamental reform. Australians are frustrated by the complexity of the tax laws and disillusioned by its unfairness. We cannot ignore the opportunity nor the responsibility that the white paper presents. The white paper reveals that if we are serious about wanting a tax system that is fair, efficient and simple, we must commit ourselves to three propositions. First, the tax base must be broadened. Only if more income is taxed and taxed at a fair rate will the system be equitable, efficient and simple. No one should delude themselves or others on this point. It is not good enough to agree with the general proposition about the objectives of reform, but to then propose some exception for income from this or that activity. The thing that has stood in the way of tax reform for so long is the tendency to argue general principles but to apply only selective measures. Secondly, the ideals of tax reform require us to commit ourselves to lower marginal tax rates. High tax rates provide disincentives to work, save and invest. Lower rates are essential to keep the Australian economy healthy competitive internationally and growing rapidly. But just as importantly, a broad tax base is unsustainable with very high income tax rates. High tax rates encourage people to engage in questionable practices. They make it attractive for them to seek ways of sheltering their income through tax dodges, and they encourage special interest groups to seek new special tax concessions and fight vigorously for the retention of present provisions. A broader base with lower rates therefore must go together. Finally, a commitment to the goals of tax reform means that in the future we should not attempt to use the tax system to solve every problem that looks too difficult to solve in some other way. Trying to solve a problem by creating a tax concession seldom works. Although it may give the appearance of doing so, we pay a high price for such false comfort, mainly the destruction of the objectives of our tax system. Before turning to questions, Mr. Chairman, I would like to make some brief comments on a couple of the major elements of the preferred package. Firstly, the consumption tax. There are three main advantages of this tax. First, it will allow a more rational indirect tax system than the current anomaly ridden wholesale tax, which has multiple rates, numerous exemptions and fails to tax the services sector. Second, it will enable us to generate tax revenue to provide for a major reduction in the marginal rates of income tax. No other tax has the same potential for this purpose. Third, it generates tax from those who will continue to evade or avoid income tax. That provides a useful net dividend for distribution to the rest of the community. The consumption tax has been designed with an awareness of the need to ensure that those who are needy and cannot benefit from income tax cuts will receive full or more than full compensation. That is a prerequisite for this measure. The government will ensure that it is achieved. There is provision for a $9 a week pension increase for singles and $14 for couples. Secondly, the virtually zero exemption single rate structure of the tax is a crucial design feature. It will assist both administration and compliance. There will be no need for new cash registers or other sophisticated equipment for business. Goods can be priced on a tax-inclusive basis. Essentially, this is a turnover tax. There is no need for the tax to be separately calculated at each sale, just as no one buying refrigerators, confectionery or stationery now has the tax separately calculated on the cash register. For business, this is a simple tax. They will also benefit from no longer carrying the cost of the wholesale tax which they pay and have to finance on their stocks. And on average, the retail tax is payable at least 36 days after it is collected, which provides a further cash flow benefit to business. The second element of the package, which I'd like to briefly refer, is to the capital gains tax. The capital gains tax proposed in the draft white paper is a moderate and sensible one. It will not affect the vast majority of taxpayers. The family home will be exempt. Only real gains from the date of introduction will be taxed. The tax will apply to the difference between sales price and present value, less the increase in inflation over the period. For assets currently held, taxpayers will have the option to pro rata the gain from the original purchase price or to obtain valuations at the time of introduction. Mr Howard has been saying that the proposal to tax capital gains at ordinary tax rates is harsh relative to other countries. He refers to President Reagan's proposal to reduce the United States capital gains tax from 20% to 17.5%. But the United States taxes nominal gains. The President's proposal stems from the realisation that the effective tax rate on real capital gains during the 1970s often exceeded 100% of the real gain. Under our proposal, the maximum effective rate on real gains will not exceed 50%. In other words, the United States tax even at a low rate on nominal gains, operate at a very harsh tax in real gains. And if there was any over-focusing yesterday on the elements of this tax, there was too much focus on the rate of it and not on the base of it. And the distinction between real and nominal gains is, I think, an important distinction, particularly when comparing it with other capital gains taxes. There's also been a chorus of claims led by Mr Peacock that the capital gains tax is a de facto death duty. This is absurd. It is true that capital gains tax will be levied on estates, but so are other outstanding tax liabilities. There will be a deemed sale of assets, but the tax will not apply to the full value of the estate. The family home will be exempt, and only the real after inflation capital gain will be taxed. On the farm, the house and the land immediately around it is also exempt. For most estates, this will be a very thin sliver of the total value of the estate. The most important point to be made about the capital gains tax proposal is that it is an essential part of any package designed to restore equity to the tax system. There is no justification for taxing income but not taxing gains, capital gains. Capital gains tend to benefit mainly the better off in the community, and tax exemption reduces progressivity. The lack of a capital gains tax lies at the core of a host of avoidance arrangements. The fact that income can so readily be converted or dressed up as capital gains is one of the foundations of tax avoidance. In conclusion, Mr Chairman, you may recall that just 3 weeks ago, when I announced the government's initial budget expenditure savings measures, I made the point that those decisions would inevitably be unpopular with some members of the community. True as that observation was in regard to this government's efforts to reduce Commonwealth expenditures, it is undoubtedly even more true in attempting tax reform. But as I said in the statement on expenditures, for too long the politically unpalatable decisions have been put off in this country because our politicians have not had the strength of purpose to tackle the hard issues. When it has come to the crunch, short-term political interests have always come first. But I think it's fair to say that, at least to some extent, the community as a whole has been prepared to let its politicians get away with that attitude. In a manner, there has been an unwritten national agreement that some things are best left in the too hard basket. The result has been, across a whole range of areas, that Australia's economic performance has been below par. This country has not been working to the peak of its achievable capacity because we as a community have not been prepared to let it do so. There is no more glaring example of this than our existing taxation system. It is decrepit and in a state of virtual decay. It is supposed to ensure that the tax burden is shared on the basis of capacity to pay, but it fails hopelessly to do that. It is supposed to ensure that people of similar incomes should be taxed similarly. It fails hopelessly on that score also. It is supposed to be an effective mechanism through which the community can raise the revenue to provide public services and assist those that it determines are in need. It fails to do that task effectively. As the draft white paper describes it, our existing tax system is a dead weight to the economy. The high rates of tax and a tax base riddled with concessions impair economic efficiency. It alters people's behaviour and diverts resources from their most productive use in the economy. The complexity of this system is notorious. It would be very easy for all of us to once again throw our hands up in horror and say, it's just too hard. We could concentrate on the case of each individual sectional group and highlight their quite legitimate concerns and worries. We could listen to the protests of those with a vested interest in ensuring that the current inequities and inefficiencies remain. We could refuse to consider the national benefits of tax reform and instead dwell only on what are the perceived losses. This government, however, believes that that option no longer exists. The time has come when something must be done. I want to repeat what I said yesterday, that without fear of contradiction, this draft white paper is the most comprehensive and ambitious document on taxation ever produced by a government in this country. It is not another study of the tax system, it is a blueprint for action. It represents a concerted attempt to define and analyse the problems of the Australian tax system, and it proposes sweeping reforms. Our existing tax system is unfair. We aim to make it fairer. Our existing tax system impairs economic growth. We aim to create a tax system that acts as a stimulus to economic growth. Our existing tax system stifles incentive. We aim to reward incentive. Through the debate now underway in the community and through the taxation summit to be held in July, we are asking the community for its support in this exercise. We are asking the community to focus on our proposals as a package and its potential for the national benefit. I have every confidence that much of the cynicism on taxation that might have developed through years of political buck passing will give way to a broader appreciation of the need for change and the honest and earnest attempt this government is making to bring about that change. Thank you.
Thank you very much, Mr. Treasurer. As we do move to our usual period of questions, I might point out to all our working press members that there is an extraordinarily high demand for questions today. Brevity will be more valued than it's ever been before. I can assure you, looking at the Treasurer's annotated copy of the White Paper, for example, you don't have to explain what's in it to him. The first question is from Richard Colville.
Mr. Keating, you spoke a little earlier of disillusionment. Are you today yourself disillusioned by the storm of criticism which has greeted your preferred option from all sorts of organisations ranging from business groups to pensioner organisations, unions and the like? And in the light of that criticism, do you realistically still believe that you're going to gain a national consensus on your preferred option at the tax summit in July?
Richard, let me say I think I could speak pretty much for the government in saying that I was very happy with the general reaction to the White Paper's presentation yesterday, and I think the press treatment of the White Paper has been very fair indeed. It is true that special interest groups have made some of their concerns known, and I hope that in the course of the debate we get the opportunity to meet some of those concerns. So I'm not discouraged by that. I expected that. In fact, I think one could say one could have expected a louder cacophony of noises from a proposal of this magnitude. But on the more general point, are we daunted by the prospect of change? The answer is no. Do we think that we can achieve a consensus? Well, time will tell. But the whole point of the summit process is to try and get people focusing on a common basis of data, a common set of numbers. So rather than people having their preferred tax option, which costs billions but makes no reference as to how the billions will be met, and all of the other various permutations and combinations of proposals which various groups can produce and claim some credit for. What the point of this proposal is to try, and the summit is to focus people on the issues on a given basis of data. And it is, I think, my experience in the 2.5 years of this government's office that to do anything in this country about structural change, one has to do it on a basis of consultation. Not always do we have a consensus. We try and develop a consensus, but with consultation there is a lot of muting of fear and misunderstanding about proposals. Now, I found that with the proposals on financial deregulation, indeed with economic policy in general. And it's certainly my view that to try and hand down a proposal like this from on high, from Parliament House, to be read in the House of Representatives and accepted by the community is just fanciful. And that's why, no matter how the government may have suffered in terms of living with leaks and innuendos and the rest, the fact is this is the price of consultation, this is the price of change. and that price is a price worth bearing, and that's why I believe the summit process is an important process in trying to get some focus on those common objectives, and common data. And with that focus, almost every group that I've spoken to in the course of this discussion, that's the private discussions I've had with business groups and the various union groups, you find once there is a focus upon some of the basic features, a lot of opposition is muted. And as that understanding grows, then it follows that the chance of consensus grows. And it's with that expectation we go to the summit, and with the expectation that post-summit we'll see a major change along these lines to be introduced by the government after the summit.
Michelle Grattan.
Michelle Grattan of The Age. Mr Keating, the white paper canvasses as a second option a 5% consumption tax. If you're forced away from your higher consumption tax, does the government regard that as a viable fallback position? And secondly, if you can't win support for any general consumption tax, will you proceed with broadening the direct tax base?
Well, Michelle, one has to understand, I think, that option C meets a number of objectives and allows, I think, in practical terms, more base broadening than might have otherwise been possible with resort to base A alone or in the context of B. And so, therefore, the reason why it is the government's preferred option is because groups who may claim to lose from some of the changes under A are compensated in part under C, but of course those who are into straight evasion and heavy avoidance can of course not only not be compensated but will lose. Now in that context we believe that A fits much better the objectives which we set out. As far as B goes, B has, for a start, we've had no reaction from the trade union movement about B. B involves the introduction of a consumption tax, and in that sense would establish certainly a rationalisation of the wholesale sales tax system, which would be desirable, albeit at a lower rate. From the point of view of our objectives, I think that's important. But though it's it is near CPI neutral with a change of only 1.5%, it would have the effect of having visible for tax items at the retail level which are not visibly taxed now under the wholesale sales tax system. So the public would be paying tax and the workforce would be paying tax at the retail level on goods which they don't pay tax on now because it is for a broad-based consumption tax, and though they would be relieved of some of the tax under the wholesale sales tax system, that might not be apparent to them. And we are yet to determine what attitude the various groups might have to be with those caveats in mind. But it is an option and we've presented it as such. As far as A is concerned, the base broadening is something which I personally believe we have to undertake, and that was always part of the proposal. There was some talk that this was sort of injected into the process along the way. I can assure you it wasn't. But the extent of its implementation would, I think, depend again upon the reaction to C and the debate in general. But certainly A or significant parts of A would need to be enacted or changed. Now, it's for you to make a judgment whether those sorts of changes constitute or would satisfy the criteria of tax reform in the broader sense, or whether indeed you think they are things which a government should do as part and parcel of its fiscal obligations. Certainly they've been left for many years and things could be left longer, but not in my view. So if you are contemplating, as you are in your question, the failure of C or a broad-based consumption tax option and asking should we go back to A and do all of it or most of it, I think the answer to that is yes.
Mike Steckney.
Mike Steckety, Sydney Morning Herald. Given that Mr Hawke said yesterday in respect of fringe benefits that government employees would be treated on the same basis as private employees, what decisions will the government make as the employer to reduce or restrict fringe benefits for its own employees, or do you think that those benefits aren't paid to government employees as a substitute for wages?
Well, it's obvious that the fringe benefits are not as prevalent in the public sector as they are in the private sector in respect of certainly income groups. But there has been a tendency across Australia to see fringe benefits wind up. Now, the visibility which a tax on fringe benefits would have, both in the corporate and government sectors, private and government sectors, is that where now fringe benefits are not considered by the government or by the Expenditure Review Committee or any of the other elements of the government, they would be considered, if so defined, by such a tax. And this point about the government not taxing itself and transfers within the government being pointless doesn't add up at all. I mean, I mentioned yesterday about us not paying for telephones to telecom. You could even extend it further and say, if government employees pay tax to the government, why tax them at all? Just give them a tax deducted salary. Now, I don't think anyone has ever accepted that principle, and therefore I think it follows that the government could impose a fringe benefits tax and elect to pay it between departments, and that's a choice it has. And in that case, its choice would be the same as a choice being provided to people in the private sector. Now, as to whether we would change the actual nature of the fringe benefits, I think, given the fact that they've not wound up, particularly in respect of the higher income groups as part of salary packages, like we have seen in the private sector, the case for change would be therefore diminished. But it would certainly be an area of scrutiny once identified, which is not an area of scrutiny today.
Peter Costigan.
Peter Costigan, the Melbourne Herald. Mr Treasurer, you and the Prime Minister have frequently said over the last 2.5 years that the expansion of employment, which is needed in the community to tackle the problem of unemployment, will come largely from the private sector. In your preferred option, there is very little for the business sector. There's no change in the tax rate, for example, and shortly the investment allowance is about to go out. You've also either imposed a new impost where fringe benefit taxes have not been paid, or are transferring those taxes from those who did pay them to the business sector. Have you taken into account the employment flow on from that sort of decision, and have you taken into consideration the fact that business may decide to retrench people who've had the benefit of fringe benefits up till now?
Well, I think you have to look at this government's treatment of the business sector over a period of time. And I think the first thing to say about it is that we've restored the profit share in Australian business in a way which the former government was unable to do. Indeed, we've got the profit share back to its late 1960s levels, and that is, I think, an important achievement, one of the important achievements of the Accord and government policy, and one which I think now Australian business appreciates, though, of course, the rings of appreciation would always be more appreciated if they're a little louder. But the fact is, as well as that, you see, Malcolm Fraser dropped the 5-3 depreciation decision with some reasonable expectation on his part that he would never have to pay for it. And given the fact that it wound up over 10 years, that even on his judgments about his political capacities and potential for survival and longevity, there was some reasonable expectation he wouldn't have been around for its significant cost of revenue to impact. But we legislated for it, we brought it in, and the cost of 5-3 which business has said, which is business understands, but nevertheless has put in its pocket and said, thank you very much, we don't want to talk about that anymore, is 50 million last year, 100 million this year, 1,000 million by 1987 and 2,000 million by 1990. Now, given the way in which the corporate share of taxation has declined, as this white paper reveals, over time for a number of reasons, profitability, minimisation and investment allowances and shelters and the like, the fact is 5.3 is a massive concession. And as long as I'm Treasurer, I'll keep on saying it's a massive concession, because as long as I'm Treasurer, it'll keep growing. The cost of revenue will keep on growing. And we'll be always reminding business of its concessional nature. And I don't think that it is fair on the part of business to say, well, look, we will take the good things, restored profitability, more demand in the economy, the introduction of market mechanisms into the economy, 5.3 depreciation, but we won't have any downside problems. We won't consider any downside issues. Now, as far as fringe benefits go, business knows it's been circumventing the Income Tax Act by the provision of fringe benefits. It may say that it was up to the government to deal with that, and that may be a valid criticism, but they've been doing it. And we all know that with the compression of rates, with the effect of inflation through the scales, that the propensity to move out of the direct tax system into fringe areas has risen and is rising, and the cost of fringe benefits therefore is exploding, and it is time to do something about it. Now, I think the route we've chosen is the best route for an effective tourniquet to be applied to this area and to stop the explosion, the future explosion of fringe benefits. And in that context, business, I think, has to weigh the benefits of a fairer tax system against all of those other benefits which this government's policies have given it. We don't think it'll have debilitating effects on industry. We don't think people will be retrenched by it. Many businesses will simply absorb it. Others may wish to cash it out to their employees. And the point about reductions in marginal rates is the fact is if a business is paying 46 cents in the dollar on fringe benefits, but the marginal rate of its employee is 35 or 50%, it is quite possible and likely in some circumstances that the business will say, well, look, there's not much point in us paying this. Here's the money. You pay the tax yourself, and we don't have to bother with this accounting procedure of, you know, hostess allowances and education for children, all of the other things which business accountants these days are engaged in, the records which they have to keep and the schemes they have to devise to put salary packages together and make them attractive. So in that case, it may be that the objective which we set for this will be met, and that is that people say, look, it's not worth doing this, here's the money, you pay the tax. And that way we bring to tax revenue which should have always been brought to tax.
Bruce Jones.
Bruce Jones, AAP, Mr Keating. Still on fringe benefits, why should a taxpayer who receives a benefit under a tribunal be treated differently to a taxpayer who negotiates a benefit privately with his employer, and might not this be seen as discrimination?
Well, Bruce, look, I don't mind to answer this straightforwardly, but the focus upon the change in this tax package to fringe benefits in the government sector is quite extraordinary. I noticed on the ABC last night someone was worried about the butler in the Prime Minister's lodge. It's a $15 billion tax change. It's the largest tax proposal you've ever seen. And there is a case for some orders of magnitude in the importance. Now, on the fringe, so I say that as a background of the fringe benefits issue. It's a part of what is a very large tax change, and the consistency in treatment, as I've said, between the government and the private sector is clear. Now, as far as arbitrated allowances go, there is a basis of arbitration. If you are referring to MPs' allowances by implication, MPs have to appear before a tribunal. We have had from both political parties a vouching of documents before tribunals for the costs of operating motor vehicles and running electorate offices and the other costs which are borne by an MP outside of the normal officially funded electorate costs, and the determination of the Remuneration Tribunal, which is of course independent under an Act of Parliament, has been to say that up to the allowance, vouching isn't required, but beyond the allowance, if anyone wishes to claim beyond the allowance, they will have to vouch it. That's the current position as it applies to MPs. If you wish to claim beyond the allowance, you have to vouch it. But I think the other feature of this is the fact that there would be, there are many arbitrated allowances in the community, and it removes from the tax office this burden of running through chits and receipts and the vouching procedures, and in that sense I don't see that there is a difficulty. What we're saying on fringe benefits in kind, the treatment of the government sectors and the non-government sectors is the same. On cash benefits, the treatment is also the same.
Barry Cassidy.
Barry Cassidy, ABC. Just following up on Michelle Grattan's question, you appeared to express a preparedness to, in certain circumstances, to abandon approach C and embrace approach A, and yet this morning certain writers were saying that you're only open to fine-tuning, not wholesale changes, that it's virtually a take it or leave it situation. What is the position?
Well, as far as I'm concerned, my mind is made up about approach C, but it's not closed. And the Prime Minister made that clear yesterday in terms of his indication that, of course, both C, A and B will be subject to testing at the summit. We've invited, as he said in the last paragraph of the document, of the last part of the last chapter, that the preferred approach, C, should be tested along with all other approaches in the summit process. Now, that's as I see it. B is we tried to design the white paper as a staging document so that any interested reader could see the thought processes, the logical thought processes which flow through it. From first of all, making it clear that base broadening alone cannot reduce marginal tax rates of the kind which there is an expectation of in the community, though we believe the base broadening is important in equity terms, and that's why it is part of both B and C, of moving to B to indicate there that with B you see a small CPI effect but a major rationalisation of the wholesale sales tax system and the introduction of a broad-based consumption tax. And then logically beyond that to one where the wholesale sales tax system is abolished altogether. You get the efficiencies of having one administration, not two. You see the revenue yield of a broad-based consumption tax, the accessing of income, either avoided or evaded, which is not accessed now by the direct tax system, but which will be accessed by a consumption tax at a higher rate than B, and that benefit, and the fiscal yield, which comes from both the base broadening and the accessing of that income avoided or evaded which is not accessed by the direct tax system. And that fiscal dividend produces the net tax cuts. And the net tax cuts, which are important if we are about having reform, if reform is important for relief to the low and middle income earners who've had to carry the burden of taxation in this country, if there's to be reform which means anything, there ought to be relief for low and middle income earners, and there is in this proposal. There is in C, because C is more efficient at getting at the income, the net income, of accessing that avoided or evaded income. And with C, it is easier to do all of B because of the consequences of the C package. And that's why I come down in personal terms most firmly in favour of C. But, of course, we're prepared to listen to the summit discussion about it. And it must be remembered that all of this goes back to the Cabinet post-summit. And then the government will bring down its tax package. This is a tax proposal, it's not a tax package. And it's at that stage that all of the considerations which come through the summit processes from public debate can be taken into account in the course of the discussion. But I'll be barracking for a broad-based consumption tax at a rate which accesses that income which is being avoided and evaded, and that is the position that the Cabinet supports. At this time it's a preferred option, and unless we hear very strong arguments to the contrary, I believe it will remain its preferred option.
Mike Lawson.
Treasurer Mike Lawson from Australian Associated Press. On page 146 of the White Paper, there's an estimate that there are 250,000 married couples or single people without children and who will not be fully compensated either through tax cuts, social security payments or the family income supplement. What does the government propose to do for these people who will also have to pay higher prices because of the introduction of a broadly based consumption tax?
Well, we, I think, have dealt in the consumption chapter comprehensively with the various groups who would be affected, and it says quite clearly that in terms of the tax system and the social security system, we estimate that 96% of people covered by those two systems will be compensated fully or more than fully by either changes to the social security rates or by net tax cuts in respect of those covered who get the benefit of the higher threshold and the benefits of the earnings of the base broadening and the consumption tax. It is true about 4% or 250,000, that is people below the threshold and outside of the social security security system, will not be compensated. Of those, we think about there are about 210,000 singles and about 40,000 couples. Some of the 210,000 singles would be students over 20 years. Those on TEAS will be compensated, though I should add, but TEAS is classified incorrectly as being outside the cash benefit system. So in a sense they are compensated, those on TEAS, but other students over 20 outside of TEAS are of course the same people on the same rationale why the government lifted the family allowance over 18 for students, that they'll be relying on the income of other people who will be advantaged by these changes. In respect of other taxpayers, there are some taxpayers in a transitory sort of stage, people studying or travelling, so that it's not possible to compensate 100% of the population, but getting to 96% and leaving those people that is those students who don't rely, who are not what you call needy. They are not needy, and of course the more general point is not all low-income taxpayers are needy. Income splitters who have low incomes are not needy. If a professional wants to give the spouse some income, but the spouse relies predominantly upon the earnings of the family to live, then that income is not needy. So income splitters, though with low incomes, are not needy. Business people earning small taxable income in any one year, who may be in a transitory position, do not necessarily should be classified as needy. Casual workers, mainly dependent on other people's incomes, again, into people who are relying on other people's incomes which have been improved as a result of these changes, would also fit into that category. And as I mentioned, students, I mentioned already, students outside of TEAS dependent on other incomes also enhanced by these measures. So that value judgment has to be made as to whether they're needy and whether we should compensate them. And the value judgment we've made in this respect, in terms of the White Paper, is that they are not needy, and therefore that's why the compensation arrangements have been limited in the way in which they have, or when I say limited, they are extensive at 96% across those in the social security system and those who come into the benefits under the income tax system and who are automatically protected by a lift in the tax-free threshold.
Andrew McCarthy.
Andrew McCarthy, Australian Financial Review. Mr Keating, you were talking a few minutes ago about listening to interest groups. Does your announcement today about the family farm being exempt from the capital gains tax represent the first move to water down the government's preferred position?
No, that was always part of it, Andrew. It's just that it was not... I mean, I'm sure this debate will reveal details that are part and parcel of the government's assumptions, or if not explicit in the white paper. And that was an explicit assumption. That was an assumption, perhaps not explicit, but certainly we made. And my addition to it, to the speech, was only on my reading of it, because I expect it to be there for you. It'll be in the version you get later this afternoon, of course. So that's not because of any pressure from the farm organisation. It's simply rational that if we are exempting the family home, you exempt the family home on the farm. And the whole question of the house and the curtilage has been one which has often arisen in this sort of context, and that's why there's a total consistency between that and the Prime Minister's general statement about exemptions in the election campaign in respect of the family home, the principal residence.
Fair coming.
Fair coming freelance. Treasurer, in the white paper it says that if you proceed with a capital gains tax and there is evidence that farms and small businesses are threatened by this tax, the government would consider special provisions. Could you tell us what sort of special provisions these might be and what sort of evidence would convince you that this was necessary?
Well, I can't do that now. I'd be prepared, what we're saying, we'd be prepared to see if the measures produce what may be at this stage an unforeseen difficulty in respect of the application of a capital gains tax in those particular categories of taxpayers. Now, I've made it quite clear yesterday that in respect, say, of farms, where we have the adjustment for inflation, that in broad acres, broadly, the inflation adjustment would remove what many people may see as a penalty of a capital gains tax, and therefore, in that respect, we've not seen that as a difficulty in respect to farms. I've already mentioned the question of the principal residence and curtilage, which would again affect that. I think there's a point, though, on capital gains which needs perhaps to be remembered about this supposed death duty element. And for the purposes of illustrating the point, I got the Treasury to take a couple of numbers out this morning, and I might just repeat them to you. If you look at an asset, and I'm going back, this is of course a prospective tax, but for the purposes of the example, I'm going back to 1973-4, purchased at say $200,000 and sold for $600,000 in 1983-4. That is from $200,000 10 years ago to $600,000 in 83-4. Over that period, the inflation rate was 185%. The proposed capital gains tax would levy a maximum tax of $15,400 under the rate scale proposed in Approach C, since $369,000 of the $400,000 gain is due to inflation. By contrast, an estate duty calculated by exempting the first $200,000 of the assets, you might remember a proposal by the Victorian government of that kind, exempting the first $200,000 of the assets and taxing at 40% on the remainder, that underlying the white paper discussion on in that respect would levy $160,000 of tax. So if you take what was that proposal a couple of years ago at $200,000 exemption at 40%, it would levy $160,000 as an estate duty compared to $15,400, which would be levied under the capital gains tax on what I think would be fairly plausible acquisition and sale figures, $200,000 to $600,000 over a 10-year period, yielding $15,400. So there is an enormous difference there, and it is that difference which the Prime Minister and I indicated yesterday to those who may have believed there was a death duty element to this, that there isn't, and that just as in any estate, if there is a tax liability, there is a call upon the estate to pay that tax liability. There will be a call because capital gains is the taxing of income. The earnings of the capital gains tax are earnings which accrue to the income of the Commonwealth. They don't go under the consumption base or the wealth base, but to the income tax, that because capital gains is a way of taking income and there's a liability at deemed realisation at death, otherwise there would never be a collection of the tax, that then this takes this position of any other liability which accrues to the Commissioner in respect of an estate. And the differences in magnitude in that example indicate, I think, that anybody who believes that this in any way could be construed as being a death duty or having death duty element is quite wrong, as we said yesterday.
Prugard.
Mr Keating, Prugard from PM. Looking at the consumption tax, do you envisage any mechanisms at all which will ensure that the effectiveness of your compensatory mechanisms for low-income earners will not suffer the ebb and flow of government budget largesse, especially in times of rapid inflation or, more importantly, perhaps directly following general elections?
No, because we've got a one-off 6.5% price effect from the approach C, option C approach, a one-off 6.5 price effect, which we are overcompensating ahead of time. I noticed someone from the pensioner organisation saying yesterday they'd have to bear this tax for 10 months before adjustment. That's untrue. The increase will be paid before the tax operates, and it would be at well over compensation. We gave the figures of $6 for single pensioners, and in fact we'd be compensating for $9. So there'd be overcompensation, and then the rest of it will be taken account of in the normal indexation. So there's nothing. What you're really asking is, are we going to disturb indexation on pensions? The answer is no.
David Bunnett.
David Bunnett, freelance. Back to the question, Treasurer, of death duties. In the guide to tax reform, which your office in the government has issued free with the white paper as a guidance to the public, it says quite categorically, death duties, gift duties and wealth taxes, the government is not proposing to introduce any of these taxes. Just having heard what you've said then and heard what you said yesterday, I still would suggest to you that the force of this depends on a semantical point, that these are not death duties because we're not calling them death duties, we're calling them capital gains taxes, and that they nevertheless fall due on people, fall due on estates that are not sold but pass at death or as gifts. Is it proper, do you think, to persist with this guide? Do you think it's not appropriate to withdraw it and replace it with something which is less controversial?
I suppose you wouldn't mind me saying, David, I'm absolutely shocked at the interpretation and analysis you've put to this particular issue. Like most of the questions you've put to me in the last 6 months, 2 years, this runs pretty much along that basis of analysis, if I can put it that way. No, I don't accept that the draft, the guide is in any way misleading. There is, in respect of a capital gains tax. Look, if we have a capital gains tax which has no, it is for a start, if income is taken as capital, it is already concessionary. It is already concessionary that it's taken on a realisations and not an accruals basis. If you earn your income, you pay tax on it. If someone earns their income as capital gain, they don't pay tax on it until it's realised. And we walk past a tax on accruals, and the concessionary nature of a capital gains tax on a realisations basis ought to be clear to any interested, open-minded observer. Now, in respect of the deemed realisation of death or gift, if we don't have those provisions, it means there will never be a realisation. There would never be a realisation if there were not gifting provisions. They would just gift to people, just gift items away, and therefore the tax would never be collected from those people and would be unfairly collected, therefore, in equity terms, on others. And obviously, the question of the deemed realisation at death in terms of the application of the tax is, I think, entirely consistent with that logic and entirely fair. And I don't think anybody can, I'm certainly the former owner won't be too worried about it, and it's a matter of whether the person who is going to operate the property in the future is going to be aghast at a tax level indicative of the kind and example I gave earlier.
Kevin Love.
Kevin Love, Brisbane Sun. Treasurer, on pensions, during the last election campaign, the Prime Minister downgraded from a commitment to a goal the 1983 pledge to increase pensions to 25% of average weekly earnings. He said at the time that fighting inflation was more important than giving money to pensioners, and that pensioners would understand that. I wonder whether, given that flexible approach to pension funding, what guarantee there is that the government won't, if it gets option C up, grab the money and run, and the 1983 pledge to pensioners will be mirrored again in a fading of the boosting of pensions promise foreshadowed in the paper yesterday.
Well, there has been in the government's term of office, that remains an objective of the government, and there has been in the government's term of office an increase in the rate of pension as a proportion of average weekly earnings. And if you care to study the point, you'll find it's been a significant increase. I can't remember the number offhand, but I think it's around 23%, and I think it was 21% or something. 21 point something when the government came to office, from memory. So that has happened. But when the government faced the 1984-5 budget, it had to make some other judgments about people in the social security area who were also poor, very poor. That is, single pensioners with children in rented accommodation, who in many respects are in more dire need of support, particularly given the difficult circumstances of some, than many pensioners may be. And we adjusted pensions ahead of the Medicare increase in 1984-5, and as well as that we gave a significant boost to the genuinely needy people in the social security system. And from memory, a single pensioner in rented accommodation with two children received an extra $15 a week, not a fortnight, but a week, from the 1984-5 budget. Now, this is another area of government priorities, and when the commitment was given in 1983, as you well know, we expected to have a budget deficit of about $6 billion. Instead, the deficit in prospect was $9.6 billion, and that was, of course, occasioned by the tax cuts which the Fraser government gave but couldn't afford to give in 1982-3 to try and move away from the 46% marginal problem which we're now facing, and because of the deterioration in the economy which its policies induced. Now, we were left with that smelly bag of fish to handle, the $9.6 billion, and we've reduced the budget deficit from 4.8% in prospect to an outcome of 4.5 in 83-4 to 3.3 in prospect for 84-5, and something well under 3 for 1985-6. And I think the progress we've made in the economy, the reduction of inflation, which affects pensioners dramatically, the fact that pensions are not being torn to shreds, pensioners' savings not being torn to shreds by inflation like they were in double digits for 10 years, is an important element in the protection of pensioners, along with the indexation and above indexation arrangements, and in this respect, in respect of Approach C, overcompensation for pensioners. So I think against that background, the implication of your question isn't quite fair, though, and I repeat that the 25% objective remains an objective.
John Beveridge.
John Beveridge from the Melbourne Sun, Mr Keating. Given the different consumption patterns of pensioners, are you attracted to the idea of applying a pensioner CPI to calculate compensation for the broad-based consumption tax? And secondly, would application of such a CPI raise the compensation payout above $2 billion?
My dear fellow, if you had read the white paper, you would have found we've done precisely that. If you look at the assumed savings ratio and price effects table on page 259, you'll find that there is a 7.5% CPI attributed to pensioners as against a 5.5% effect for someone on a higher income. So we've not only assumed a different basket in terms of the inflationary impact, but we've also assumed savings ratios which we think are generous in terms of the saving content. So the compensation is not simply assuming that there is an element of saving and expenditure, but assuming total expenditure and the rundown of savings. And it is on that basis, with their own CPI, that the pensions are adjusted, and that's why the pensions are, we say, overcompensated.
Okay.
Mr. Keating, do you accept, as the Prime Minister appeared to yesterday, that the logic of this package points towards a comprehensive system of taxation indexation in order to preserve the real benefits given, in particular people on the lower marginal tax rates? If you do, are you prepared to hold out this option to the ACTU over the next few months? And if not, then are you prepared to go into the next election campaign with some sort of in-principle commitment to this policy?
Well, Paul, if the broad thrust of C were to be introduced, if the government can get to the stage that there's broad community support for C, I would very strongly support full indexation of the income tax scales, and on that basis it would be, if that were a view the Cabinet were prepared to accept, that would be, of course, a fait accompli and would therefore be our policy. It's a matter, the point the Prime Minister made yesterday is that that's not a commitment we could give without this repair to the income tax system. But to answer both your questions in the affirmative, as far as the ACTU is concerned, I'd be quite prepared to hold that out, because I think the worst outcome of this would be to now develop a base in consumption to relieve the problem of tax by stealth and compression of the rates, where we've had massive increases in tax without any legislative change, to find that in 10 years' time or 15 years' time we're staring the same problem in the face again. And for this kind of change, I would be prepared to recommend to the Cabinet, if we were to get this policy through, to recommend to the Cabinet that we fully index the tax scales.
John Short.
John Short, Sydney Morning Herald newspaper. Mr. Keating, the White Paper makes it clear that a capital gains tax is necessary to close off many of the continuing tax avoidance practices. Given that, the White Paper makes it clear that a capital gains tax is necessary to close off many of the continuing tax avoidance practices. Given that, how does the purchase of a holiday home by an ordinary wage and salary earner amount to a deliberate attempt to convert income to capital, given the fact that such a holiday home would of course be caught by the new tax?
Well, I don't think anyone who's bought a holiday home that you can make the linkage between that being an explicit tax avoidance device. If somebody's been prepared to buy a holiday home and enjoy it for its recreational value, I understand that. But if we are to make an exemption of the principal residence, which is concessionary in this tax, which the government is prepared to make, then it follows that that all other assets ought to be assessed for the tax at the point of sale or upon realisation, whenever. And I don't see the application of a capital gains tax in this respect in any way being that in any way anyone could argue that in applying that somebody who has bought a holiday home has been in the tax avoidance business. I think it's nevertheless true that without a capital gains tax, a lot of the artificial schemes that we've seen in the past wouldn't have occurred, and the artificiality and contrivance of a lot of avoidance schemes come down to the fact that there is no tax on capital. And as both the Prime Minister and I have said, that's one of the important equity reasons for such a change, and I think that's pretty well understood by the community.
Bob Bowden.
Bob Bowden, Treasurer. Mr. Keating, having succeeded in reducing inflation from double figures, I'm wondering how you now justify a package which threatens to push inflation to as high as 15%, and even accepting that the ACTU will agree to discounting. Do you feel that these extraordinarily high inflation rates, how can you guarantee that they won't impact on inflation, generally interest rates, the exchange rate and economic conditions generally?
Well, I don't know where your 15% came from, Bob, but there is no doubt a one-off 6.5% price effect. But what I think has to be understood, and of course in a change of this magnitude would be well understood, that it is a price effect and that there would not be an inflationary effect because the government is not prepared to see this price effect run into inflation by what the Prime Minister referred to yesterday as a potential for double dipping by employees who have the benefit of net tax cuts lining up for an indexation increase. Now, that's not on, and therefore the price effect would remain a price effect and not an inflationary effect. Now, the fact that there is a price effect is unavoidable in developing a base in consumption of this magnitude, and it is there for a period of time, but it will wash out of the system, and I don't think that Australia's inflation performance, underlying inflation performance, or its economic performance will be deteriorated from by a lack of understanding of the fact that that this is happening. And I'd be very surprised if financial markets or any other market or the business community in general or the inflation psychology of the country would be in any way impaired by, that is the improved inflation psychology of the country, but in any way impaired by the fact that there is a known one-off price change for which they have well over 18 months of notice and for which has been the basis of a major debate.
Our last two questions. First, Greg Hywood.
Greg Hywood, Financial Review. Mr Keating, it's now common knowledge that you have often been more enthusiastic about your tax reform package than the Prime Minister. As reports of these differences have become public, it's tended to undermine the perception of the Prime Minister as a strong leader. Are you completely satisfied that your determination to achieve your preferred option has always been consistent with stability within the government, even when now there are some people within the government who have qualms about the package? And if this proves to be an electoral disaster at the next election, what degree of responsibility will you take for that outcome?
Well, I probably take more responsibility for my actions than you take for yours. But because changing the tax base of the nation has little more gain for it than reporting corridor chit-chat, and I'm not going to be diverted from higher and more important duties, if I can use that term, to be distracted by the scuttlebutt of the corridors. Now, on the more general point, I've been given the executive responsibility of administering the Australian taxation system. And in the course of 1984, the government made it quite clear that it was embarking on a program of tax reform. As early as March 1984, we gave EPAC a reference on tax reform. Throughout the June conference of the Labor Party, we made it quite clear that the discussion at that conference was in terms of wholesale tax reform, and at the election we made it clear that we would have a complete review of the tax system leading to a taxation summit. After the election, I was, in the normal fashion of my responsibilities, involved with starting that process, and I started that process entirely with the Prime Minister's support, and his support in that process has never wavered. And though it may suit some people to try and suggest that there's some difference between the Prime Minister and me in this respect, that's not true, or worse, that there's some rupture of our relationship, is entirely untrue. And the harmonious and friendly relationship which I have enjoyed with him, the pleasure of that relationship which I've enjoyed, has been, I think, one of the strengths of the government in terms of keeping that important office and the important office I have working in harmony. And I don't think anyone here seriously believes that that Bob and I have had anything but the best of personal relationships, and that continues. As far as the outcome is concerned, one has to do what one believes is right in the final analysis, and I believe this is right, and that's why I'm doing it. If there are any kicks in the backside to take, I'll take them.
Finally, Bruce Chuddery.
Bruce Chuddery, Australian Business Magazine Treasurer. Earlier you expressed some disapprobation of questions on perks and fringe benefits. So I won't ask you the question I was going to ask you, which was, but you can answer it if you like, which was how are you going to tackle the state government and state public authority subsector, given that you can't tax state governments or their wholly owned controlled statutory authorities. Would you consider introducing a direct to the employee tax to handle these people? However, I'm not asking that question unless you want to answer it. Well, I'd rather go to a more philosophical question. On page 7, you say that of your speech, you say that trying to solve a problem by creating a tax concession seldom works. Though it may give the appearance of doing so, we pay a high price for such false comfort. It's less than a week since your colleague, Senator Button, announced a 150% tax write-off scheme to encourage research and development. How long, in your, on the basis of your philosophical statement here, do you think it will be before that scheme of Senator Button's collapses, and how hard will you be working to undermine it?
Was that the last question? Right. Well, look, the point I make is a general philosophical point, and I stand by the point. I think the difference in respect of the business tax concession in respect of research and development is it's not generally available. It is not available to all taxpayers. You can't simply just take it up in the way in which other concessions have been taken up. There will be a licensing procedure, and in the same way as we've used the management investment companies process to give the benefit of a tax expenditure, but limiting its blowout potential, if you like. That limitation is here in the quality of the qualifying arrangements for the take-up of that tax concession. And we believed that because of the difficulties of making grants available and firstly making a value judgment about grants for research and development, that the tax expenditure route was a more appropriate route. And that's what the government has chosen to do, and that's why I don't think you can make a comparison between the nature of that tax expenditure and the more general point I made about tax expenditures being worked to death for minimisation purposes. And that's why the two decisions, that decision and that remark, is entirely consistent.
Mr. Treasurer, thank you very much. I don't recall when we last had such a protracted list of diverse questions about an issue which obviously has affected everybody in the country just about as sharply as you thought it would. Yeah. Thank you very much for joining us today, and when we next see you the day after the budget, I hope that all of us will be better informed about what today has led to.
Thank you. Thank you very much. Yeah, they did, yeah.